We've got some money tips for 2023, plus some tax changes to talk about as well. Sort of a continuation of some conversations that we've had last week on the program, but we simply ran out of room because there's so many different money tips to give in the beginning of a new year, and so many tax changes as well, particularly the slew of them that got jammed into the budget bill that passed the last week of 2022. We're going to be joined by our fellow certified financial planner, certified financial fiduciary, and CPA, Kristen Cayley, part of the folks on the team at Nelson Financial Planning, later in the program to go through all of those tax changes. So welcome on in to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. My name is Joel Garris. I'm a certified financial planner and a certified financial fiduciary at Nelson Financial Planning. So before we get to the money tips for 2023, always good to talk about the headlines that were this past week. Chief among them, the reading on inflation that came out on Thursday morning, continuing the trend, now a 6-month trend of seeing that inflation number gradually come down. And folks, that is good news across the board, because if you've been walking through the grocery store aisles of late, you know that things are certainly costing a little bit more. Now, part of me, and maybe this is because I'm a little jaded and skeptical at times, part of me can't help but think, is this really like inflation, or is this just an opportunity for some businesses to maybe say, hey, it's a good time to raise prices, increase profitability, particularly when everybody's talking about inflation. So maybe we are experiencing inflation as a business, but maybe we're not. Still a great time to try and sneak in that price increase now, isn't it? I wonder how much of it is inflation versus that. That's one of those things that, of course, you and I will never know, but I've got my suspicions, if you will. Anyway, the reading on inflation came in at 6.5%, certainly a market improvement of where we were in June when that rate was peaked at 9.1%. So a good trend, certainly something that we are keeping an eye on, because that also goes hand in hand with what Jerome Powell and his buddies at the Federal Reserve are all about. If you're a regular listener to the program, you know that over the course of the past several weeks now, we've been expressing some concern that are they raising rates at too quick of a clip without really giving it time to ultimately see how those rate increases ripple into the economy? Remember, if you think about a rate increase, it's not like instantaneous in terms of its economic impact. Generally speaking, when you raise rates, it's about a 6 to 9 month period of time before you will ultimately be able to really know exactly what went on or what the impact was on that rate. And last year, what'd they do? Like a ton of them? And ultimately, a lot of them, particularly the ones that they did in the back half of the year, right, haven't really had time to sort of work themselves in. Meanwhile, already seeing some encouraging numbers on the inflation side. So we would encourage the Federal Reserve, assuming that they are an avid listener of Dollars and Cents, to maybe give it a moment, a month or two, to see where some of these rate increases wind up ultimately going in terms of the impact that they are having. Sure hope they are listening to that advice from little old me. Anyway, speaking of advice from little old me, we started this last week. We wanted to continue it this week. These are some money tips for 2023, right? Beginning of a new year. Always a good idea to kind of make those resolutions or think about, hey, there's some ways in which I might be able to improve on my finances. If you recall, last week we talked about 3 of them. We're going to talk about 3 more this week, one of which was to perhaps look at earning more on your savings, right? I mean, that's a novel theory, but the reality is that there's a lot of options out there that are paying a much higher interest rate than perhaps your large banking institution is willing to pay right now. So we encourage folks to shop around. Same thing in terms of shopping around as it relates to your banking services as well. A lot of times the average customer will keep their checking and savings account at a banking institution for an average of 17 years. As we commented last week, that's longer than most marriages. And the reality is the big banks sort of know that, and at the end of the day, that's why you haven't seen them increase those savings rates as much as they probably should be at, given where we are on interest rates, especially when you think about mutual fund money markets that today, many of which are paying more than 3.5%. That's a pretty decent number. Not great, especially when inflation's still at 6.5%, but at least that's better than the 0.00001 that we've been getting for the prior decade. And then the third item, monthly subscriptions. This one is out of control. I think the average millennial last week we said had about 17 different, or maybe it was more than 20. I forget what the exact number is. It's a lot of these monthly subscriptions. You know, back in the day, there was like one, like we all had like one. It was like to the YMCA. Now it is to a host of platforms. That is how they ultimately wind up generating their profit, is getting you on these monthly subscriptions and then making it sort of difficult to ultimately stop those monthly charges. So make sure you check that out. Start the year off right. Along those same lines, we would also encourage folks to negotiate, especially when it comes to monthly services versus those monthly subscriptions. Your cable bill, your cell phone bill, those are some things that top the list, if you will, of opportunities. Oftentimes, all of these companies are running ads that offer deals or discounts to new clients. The reality is it costs more to obtain a new client for these cable or cell phone companies than it does to retain an existing one. So perhaps you take that and play that to your advantage. Maybe they'll match a competitor price. Maybe they'll offer a promo. Those are the kinds of things to certainly engage in conversation. Beware those promos, though, you know, like the 0% until like 2030 kind of thing. What's happening there is if you miss the ability to pay all of that off by the time that expiration date comes, then you're going to wind up paying a much higher cost on whatever it is that you got the special promo rate on. So, and then when it comes to that, if at first you don't succeed, try again. Maybe next time you'll get a little bit more accommodating service rep. Maybe they had a good morning and they're feeling good, and you might be able to get a little bit more of a discount. So fourth on that list of some of these top money tips that you can do in the new year is don't be afraid to negotiate with those monthly services that we all have on a regular basis. Number 5, and I guess this makes sense, right? Check your investments. After all, this is a financial show. You certainly want to take a moment and check your financials, particularly your 401ks. Much higher limits. We're going to talk about those limits again later on in the program in terms of how much higher those 401k limits are, but also less and less choice in those 401k platform. So we got a couple more items that we want to talk about on this list, but we're going to take a break. When we return, we'll continue the conversation here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We're talking about some of the top money tips that you can implement in a new year to help improve your finances. We've talked about shopping around when it comes to maybe a bank account or a cell phone or cable service, along with looking at those monthly subscriptions that we all have and maybe eliminating the ones that we're not using anymore. In this segment of the program, but we're joined by our fellow certified financial planner, certified financial fiduciary, and CPA, Kristen Cayley. Good morning, Kristen. Welcome to the program.
Good morning, Joel. Thank you for having me.
My pleasure, as always. You always come with lots of good information because the reality is that the tax code changes on a regular basis, doesn't it?
At least once a year.
At least once a year. At a minimum, it's going to be once a year. And here we are in a new year talking about some of the money tips that folks can engage in. Before the break, we were talking a little bit about the importance of checking your investments, particularly when it comes to your retirement account. That's one of the things that we talked about last week. Those contribution limits have changed for the year 2023.
They've kind of gone up across the board. So higher limits for almost all accounts.
Much higher limits or much greater increases this year than what we've seen. I think both the percentage and the magnitude was the largest. Again, it all goes back to the inflation story, which we were talking about in the first segment. What are those limits now for your typical 401k?
So for 401ks, it went up from $20,500. It went up $2,000 to $22,500 in 2023.
And then on top of that, then if you're over 50, then you can do a catch-up, which gets you, I guess, all the way up to $30,000 total.
Yep. So the catch-up is $7,500 now.
And then on your traditional IRA, Roth, any changes there for our listeners to know about?
A little bit. So it went up from $6,000 to $6,500.
Okay, and the catch-up stayed at that $1,000 level.
So a little increase.
So the key point there is, obviously, if you've got these larger contributions, one of the things that you need to do when you're checking your investments to start the year off is to make sure that your contribution levels mirror these increases in the amount of money that you can fund these accounts, whether that's your 401k or your IRA. And of course, particularly on 401k platforms, and we've certainly talked at length in prior episodes, really take a moment to look at your investment allocation. We see this all the time where more and more 401k platforms have really reduced down what the options are for employees to select from, and in essence, forcing them into these target date funds. And there's two concepts on these target date funds that I think bear repeating, and one of the reasons why we're not particularly big fans of them. First and foremost, they wind up adding in a bigger bond component earlier than you think. So it's not enough to just select the year and say, oh, that's the year I'm going to retire, so that's the target date fund that I want. The reality is that you would be surprised at how large the bond component is. They intentionally do that to make sure that nobody can complain when things go wrong, because they say, oh, well, there was a bunch of bonds in there and that was all fine and dandy. The reality is, particularly if you've just gotten through 2022, sometimes the bonds don't hold up the way that they should. And so it's important to know what that percentage of the bond mix is in your target date fund. The second point is the international piece. And this is the piece that I think surprises folks and not necessarily something that they look at. Typical target date funds can be anywhere from 30 to 35% on the international side. So, and we're certainly would say, you certainly want to have some of that because there's certainly plenty of great companies that are headquartered outside the U.S., but that's a little bit high in our opinion based upon sort of where things are relative to what's going on economically in the rest of the world. So make sure you check out those investments, particularly on your platforms that you would have with your employer, your 401ks, and whatnot. And then lastly, and Kristen, this was something that we talked about last week. Boy, folks really want to check their tax withholding for this year, don't they?
Withholding has gone up, or the penalty for not withholding has gone up pretty dramatically. So it was 4% in 2022, and now it's up to 6% and probably going up to 7%.
And that's a reflection of just simply where interest rates are. As the interest rates go up, then that cost is ultimately going to be borne by you, the taxpayer.
Unfortunately.
Because you've got to make sure that you're putting in that money along the way. We have, I think you talked about last week, as a sort of a pay-as-you-go type of system, right? It's not a wait to the end and then throw it all at us.
No, they want their payments early, so they want them as you get paid.
That makes sense, and they especially sort of need that money. So certainly something that folks should look at. And I guess this serves as a nice segue into an extension of the conversation that we were having last week in terms of the top 10 tax changes for the year 2023. We've added a couple more just this past week. So we've got like it's like a top 10 list. We did half of it last week. We're doing the other half this week, and then we've got an extra 2, if you will, for folks to be aware of. And one of the things on those big tax changes is just how much has changed, and not to repeat everything we said kind of last week, but certainly conceptually, when you look at all of the tax changes that happen, some good, some bad. The IRS sort of gives with one hand, takes away with the other. What were some of the things that they did on sort of the plus side in terms of kind of what their changes were that would actually benefit taxpayers, if you will?
Mm-hmm. Yep. So we just touched on this. So they increased the limits for almost all sorts of accounts. So you can add more to retirement accounts, HSAs, things like that. They also increased the RMD age. So we spoke about that last week. So it went from 72 to 73.
That's a nice little change. It certainly helps people out in terms of not having to take the required minimum distribution.
Mm-hmm.
Right.
Yep.
And then the other big change was they delayed that whole crazy 1099K rule.
Mm-hmm.
Boy, that was just absolutely ridiculous in terms of what they were attempting to do on that.
Mm-hmm. Yeah, so that's delayed until next year.
So you still got to deal with it, but that's the rule that says if you have any type of online business or sell anything online, whether it's eBay or Etsy or Ticketmaster, you've got to reconcile that with the IRS.
Right.
And that's the point of having the 1099K. Fortunately, they did delay that, but it's coming, and that's certainly an area that the IRS looks at. In terms of trying to generate additional revenue. So those are sort of the things on the plus side. On the negative, my goodness, all of the stuff that has benefited taxpayers over the course of the past couple of years as a result of COVID, that's all gone.
Yeah, so the stimulus checks, those are gone. The advanced child tax credit payments, those are gone. Certain charitable deductions are also gone. And then dependent care, the enhanced dependent care credit, gone back down to what it used to be.
So that's going to be a big deal for taxpayers because those are huge differences. And the reality is it goes back to if you didn't pay enough in, then not only are you going to have to pay it, but you're going to have to pay a higher level of interest. So folks really do want to be taking the time to check what their tax withholding is for going into this year, 2023.
Yeah, especially to avoid 7% penalty on that.
That is correct. Yeah, so no more child tax, no more stimulus, no more dependent care, no more above-the-line charitable contributions either. That was one of the ones that certainly disappointing to see that go away to the extent people were able to write off a little bit. It was never a big amount, $600 per couple, to be able to write that off. That has certainly gone away this year.
Mm-hmm.
So I guess let's shift gears then. So that's sort of the recap of what we've already chatted about. If you missed any part of that or want to check it out again, simply go to our YouTube channel where you'll see our conversation about the first half of the top 10 tax changes for 2023. Also, if you are a podcast listener, well, then you know how to find us. Just go to your favorite podcast platform, search for Dollars and Cents with Joel Garris of Nelson Financial Planning. If you have trouble finding our channel on your favorite platform, well, then just go to our website, nelsonfinancialplanning.com, and you can find our channels in the upper right-hand corner. Click on one of those icons that looks most familiar to you, and you'll get immediately connected. We're going to return after these messages. We're going to talk about some of the other big tax changes for the year 2023 here on Dollars and Cents with Joel Garris and Kristen Cayley of Nelson Financial Planning. Talking about some of the big tax changes that occurred for the year 2023, and certainly some things that you need to be aware of as you start to put some paperwork together to complete your 2022 taxes. Joining me on the program again this week is our fellow certified financial planner and certified financial fiduciary. She also happens to be a CPA, Kristen Cayley. Welcome again back to the program.
Thank you, Joel.
Very good stuff. As we were saying before the break, if you missed any part of the conversation last week, make sure you check us out on our podcast platforms and YouTube channel. Go to our website, Nelson Financial Planning. Upper right-hand corner, you'll see all the icons. Click on the one that looks most familiar to you, and you'll get immediately connected. Okay, so now we're talking about sort of the other part of these tax changes. I guess we'll start with perhaps one of the biggest changes that people might actually see a benefit on, and that is some of the improvement in terms of energy efficient tax credits that were around and then disappeared, but now they're back. So catch us up on what's going on there.
Yeah, so one of the ones that I think will impact a lot of people is the home improvement energy credit. So that used to be a $500 lifetime credit. So if you had any sort of energy improvements, so new windows, doors, AC units, something like that qualified for the energy credit, you were limited to $500 credit for your lifetime.
Which means, okay, so I only can replace my windows once in my lifetime. Okay.
And get a benefit for it.
And get a benefit. But that's gotten better.
Yes, so now it's gone up a little bit. So now it's up to $1,200 per year.
That's significant. The per year part is significant.
Yes. Yeah. So things like windows, AC units, doors, those would all qualify for this credit.
Well, so that is good. Now, is there any particular income limitations that taxpayers need to be aware of on that at this point, or is that generally available for folks?
I believe it's generally available.
That's great. Okay, so so that is good stuff. That's probably one of the gaps or the details that have yet to get fully filled in, which is why we always encourage folks to listen to the program regularly as we hear more from the IRS to help fill in the gaps. But what's the deal with solar panels? Because there's got to be some stuff in there about that as well.
So those have actually always been a pretty big credit. So it used to be 26% of whatever you paid would be a credit on your tax return. That has now gone up to 30% of cost. And it'll stay that way through 2032, so about 10 years. And then it's going to start to decline back to 26% and then down to 22% of your cost.
Okay, so I guess the theory there is that by 2032, is that the year? We'll all have solar, and then you won't need the credit as much.
Apparently, that's the push right now, solar panels.
Okay, we'll see how that goes. So next up is the vehicle stuff, right? So a lot of this stuff was part not just of the budget bill that passed at the end of last year, but this goes back to last summer, August, with the oddly named Inflation Reduction Act that focused more on clean energy things and credits and things like that, and also some Medicare stuff. And we've certainly talked about some of those big Medicare changes in prior programs. Tell us about some of this clean vehicle stuff. How is that going to work? Should I run out and get a Tesla this week? What should I do?
I don't know. The way they wrote it and the requirements make it kind of difficult. All right, so we'll give you the rundown here. So essentially, they're keeping the $7,500 credit for electric vehicles, so clean vehicles, but they are adding some requirements. So the first requirement is you have to have a modified adjusted gross income, so that's your taxable income essentially. Can't exceed $300,000 for married filers or $150,000 for single filers.
Okay, so that one's got an income qualifier versus if I get a new AC unit or something like that. Okay.
Yep, and then so the next requirement is that the vehicle itself has to have an MSRP of $55,000 or less.
Okay. Can you get a Tesla for that?
I don't think so. So that's what I'm saying.
Yes.
It's the way it's written with the requirements. It's not. Don't think it'll be too used.
Elon's going to have to cut his profit margin if that's okay. All right.
And
So what else on that?
And then final assembly must be done in North America.
Okay. So final assembly, because obviously parts are going to come from, but the way you ultimately put it together, it's got to be in not the U.S., North America. So it could be Canada, Mexico. Okay.
And there's kind of a timetable on that. It's not all immediate, but they want it to kind of go over the next 10 years where all of it is done in North America.
So if I wanted to know which type of car would qualify, where would I go for that information at this point?
So right now, the Department of Energy has an online website that has links to cars that would qualify, and the IRS has one too, because as you can tell, it's kind of complicated to figure out what vehicle actually qualifies for this. So they've tried to make it a little bit more simple, but I don't think there's too many vehicles that actually qualify.
And the Department of Energy doesn't charge me like a finder's fee, right? If I go and like buy a car off their website.
No, they kind of just identify which vehicles themselves qualify.
Good. You never know. Government might be trying to squeak a little bit out of this whole thing. And I guess some of these credits also apply to used cars as well, which is really the first time we've seen anything like that.
Yep. So this is for the previously owned clean vehicle credit. So it's up to $4,000 per vehicle on your tax return. This one also has income limits. So this is limited to $150,000 for married filers and $75,000 for single filers.
Okay, so definitely some things for folks to be aware of there. I guess the caveat is make sure that you are getting a vehicle that sort of checks these boxes in order to get the credit in the first place.
Yeah, but on that one, it needs to be at least 2 years old, the model, and then it has to have a price of $25,000 or less.
Okay, again, there's some pricing restrictions on these. You can get the car, but it doesn't come with a battery. Okay, all right. Well, so that's the situation with those tax credits for cars. Let's shift gears and talk about healthcare and marketplace insurance, otherwise known as Obamacare. What's the latest on that?
So essentially what happened is they have removed the upper limit. So it's a 400% upper limitation, and they replaced it with just an income benchmark of 8.5% through 2025. So essentially what that means is as long as you're paying in at least 8.5% of your income towards the insurance, then you are eligible for a premium tax credit.
So that's a nice change for taxpayers, because certainly we've seen it in years where it had sort of that cliff provision, whereby if you were above that 400% of federal poverty line, you could see all of the credit get pulled back. And that in some instances, I remember seeing $13,000, $14,000 of that happening. I mean, that's how draconian that was as it related to getting marketplace insurance. So the good news now, though, is if it's just based upon AGI, it's not as dramatic as it might be. So for some reason, my income jumps up. I went on the exchange, put in, I'm going to make, $50,000, and then all of a sudden my income jumps to $100,000. Then that's going to be limited to $8,500 in terms of that cost based upon that 8.5%. So that's a nice little benefit for taxpayers. How long is that particular thing around for?
Through 2025.
Okay.
So this has actually been around since 2020, the COVID era sort of legislation, and they've just kept extending it. But this is the longest extension through 2025.
And really does give some flexibility for folks that want to use the exchange. But really, sometimes you can't control what might happen to your income. You get a bonus, you inherit money, things like that. All of that would go into your income and ultimately drive where you would fall in terms of that total income line. So what's next on our list?
So the last one here is just kind of reminding everybody that this is the last year, so 2022 tax year, for the coronavirus related distribution. So if you took out you had able to take up to $100,000 back in 2020 from your retirement accounts. If you did that and then split it over the 3 years, this is the last year that you'll have that phantom income on your tax return.
So that is good, because sometimes people sort of forget that, and then all of a sudden it's like, yeah, you got to put a third of what you did 2 years ago back on the return. Now, folks still have the ability to repay that as well.
You have until the end of 2023 to repay that.
And then if you did that, you'd have to go back and amend your 2022, 2021 returns. But if for some reason you wind up with a windfall and want to put that back into your retirement account, you actually still have till the end of this year?
Yep. So you have 3 years from the date that you took the distribution, so it could be up until the end of the year.
Wow, that's great. So certainly some things for taxpayers to be aware of. When we return, we're going to talk about a couple of more tax changes that we've sort of added into the mix just over the course of the past couple of weeks here in 2023. So stay with us through the break, and we'll return here on Dollars and Cents with Joel Garris and Kristen Cayley of Nelson Financial Planning. So on the program, we've been working through not just money tips for the new year, but also tax changes for the new year. Joined on the program this week by a fellow member of the team at Nelson Financial Planning, Kristen Cayley. Welcome to the program, as always.
Yes, thank you, Joel.
Good stuff that you're sharing with our listening audience. Of course, this is your expertise, right? Not beyond just being a certified financial fiduciary, certified financial planner, you also happen to be a CPA.
Yes.
So this is right up your alley in terms of some of the tax changes. We've covered sort of the ones that we readily identified at the turn of the year. This segment, we're going to add a couple of more into the mix that happened quite late in the year. And the first one has to deal with something that's been getting a lot of headlines of late, but unfortunately in a pretty negative view in terms of the bankruptcy of FTX, the FTX crypto exchange. Tell us what changed in terms of cryptocurrency platforms and trading houses in terms of what their requirements are.
Yeah, so it's no secret that the IRS has been trying to go after these crypto transactions for the past couple of years. So what they were going to start doing is on January 1st is requiring these crypto brokers to produce a 1099-B, which reports gains and losses. So essentially trying to capture those transactions.
And that 1099-B is something that we typically see when it comes to mutual funds, obviously outside of an IRA. It wouldn't apply if it was inside of an IRA, but anything that is what we refer to as a regular investment account or an after-tax account or a trust account, anytime you do anything in there, it's going to generate out a 1099-B. This requirement was going to apply to all of the crypto land, if you will, effective January 1, but they said no.
Yeah, they postponed it.
They gave them an extra year, much like they did on the 1099K stuff. They also gave an extra year on that. Now, this one, though, cuts the other way. And so if you are someone that has done some of that cryptocurrency stuff, you probably want to take a moment and still report it. Well, the reality is you're required to report it, but particularly this one may kind of cut against you because of what's been going on with cryptocurrency during the course of 2022.
Mm-hmm. You kind of have the potential for a loss if you sold some transactions last year.
And then that loss is one that you could use on your tax return, thereby reducing your tax liability. So, So as nice as it was for the IRS to kick the 1099K piece down the road, this one they kicked down the road, but this one actually could be the detriment of the taxpayer.
Mm-hmm. Yeah. Unless you've been keeping track of your cost basis in these sorts of transactions, it's kind of hard to report them if you don't have all the information.
Right, and certainly that's the point of the 1099-B is to give that information in a consolidated format. So that was obviously a last-minute change as well. Buried in the budget bill was some provisions involving being able to convert 529 plan balances over to Roth. So why don't you set the table for us and recap for our listening audience what 529s are and what they do and sort of how they operate.
Yep, so 529 plans are a way for parents, grandparents, even individuals to save for college. So essentially what happens is you put in money into the 529 plan, it can grow tax-free, and it can come out tax-free as long as it's for education purposes.
Certainly a very valuable and useful mechanism, useful account for being able to fund college. I know all three of my boys are at schools, and 529s are certainly very helpful in terms of helping to cover those costs.
Yeah, and they operate very similar to a Roth IRA in that there's a 10% tax penalty on if you take it out and you don't use it for education purposes, much like the early withdrawal penalty on a Roth IRA. So
some similarities, if you don't use it the way you're supposed to, then you're going to get hit with tax consequences.
Right.
So then, and 529s have become incredibly popular, more so than one might think out there these days.
Yeah, that's particularly because there's not really any limit on contributions. So you do have your annual gift limitations. So that for 2023 is $17,000 per person. But you can even lump together 5 years worth of gifts and make a one-time contribution to a 529 plan for up to $85,000 per person.
Right.
So if you're married, that could be up to $170,000.
It's a pretty significant way to kind of shift money into an account that's going to grow on a tax-free basis, again, assuming you're using it for educational purposes. Another important piece to remember on 529s versus other types of educational savings accounts, there's no income limit. No matter how much money you make, you can still put money into a 529.
Right. Yep.
So that increases their popularity quite a bit. So what does the legislation talk about in terms of what features does it sort of bring new to the table, if you will?
Yep. So they're trying to target the people that still have balances in 529. So let's say the kid doesn't go to college or gets a scholarship, and the 529 just kind of sits there with a balance. So what you can do is now you can roll over the 529 balance to a Roth IRA, but it has to be for the beneficiary. So it's going to be for whoever the kid it was set up for in the first place. But there are some limitations on it. So it's limited to whatever the Roth contribution limit is per year. So for 2023, it would be $6,500, depending on what that limit is in 2024. Kind of would change year to year, but you have a lifetime max of $35,000. So that's the maximum you can move from the 529 over to the Roth IRA.
So basically, like you've got like a 5-year window, if you will, that you could take a part of that 529 and basically shift it over to Roth. But to your point, that would count as the Roth contribution. You wouldn't be able to put fresh money on you wouldn't be able to double max it out. Meaning the 529 would count as the actual contribution to the Roth IRA.
Right.
So then all the regular we presume, and again, this is one of those areas where we haven't seen the full IRS guidance on this, but we would presume then that the same types of rules would apply in terms of being able to fund a Roth.
Correct. Yes.
So income limits, you've got to work, all of those types of things would come into play. So in essence, if you've got a leftover balance in a 529, then this is a way that you can use that leftover money to, in essence, fund your Roth. Mm-hmm. And that's the key element, if you will, of that. But it is interesting how much the 529s have proliferated over the course of the past many years. Something like 15 million, with a total of how much in assets? Quite a bit of money sitting in them.
I got a statistic here. So the Investment Company Institute says that nearly 15 million 529 accounts at the end of 2022 were holding a total of $480 billion.
So that's a whole lot. So the average balance, about 30 odd grand, give or take.
Yeah, which kind of aligns with the 35,000 lifetime cap that you're allowed to.
Okay. Oh, you're saying that the folks in Washington put some thought into that number? That's amazing. All right. But really, this is one of those ones that I think, who's it really benefit, right? I mean, if you're going to school in the year 2023, it's so incredibly expensive. I mean, who's this really helping?
Yeah, a lot of people say it's just kind of a handout for the wealthy, since they're the majority of people that do invest in 529s. The median wealth and all that for the 529 plans is for the higher wealth.
For the higher, yeah. So somewhere along the lines of median wealth of about 400,000 or something. So again, this one, anyway, we'll have more on it in future shows because the IRS has to fill in a lot of the gaps on this one as well. But hope you found all of that informative. If you like what you heard, feel free to give us a call this week at the office at Nelson Financial Planning, 407-629-6477. With that, this has been Dollars and Cents with Joel Garris and Kristen Cayley of Nelson Financial Planning.